This is how a group of strangers on the internet saved a dying company, became rich, and killed a $12 billion hedge fund for fun. It's 2019 and GameStop as a company has been declining. Online gaming had changed how people played games, and they were in for some bad news. They announced they were closing 200 stores for underperforming. GameStop's stock continues to fall all the way to $1 over the next year, and the company looks destined for bankruptcy. Hedge funds are confident that GameStop is dying and have shorted the stock. Instead of buying a stock and hoping the price goes up to make money, shorting is when you borrow a stock and sell it at the current price. Hoping that the price goes down so you can buy the stock back at a cheaper price. It's important to understand that shorts have to return the stock to whom they borrowed it from, even if they have to buy the stock back at a higher price. Shorting is betting a stock will go down instead of up. But something happens in August of 2020. Ryan Cohen, the co-founder of Chewy, announces he's bought a large stake in GameStop. People start to speculate that he's trying to save the company, so they start buying stock too. These new buyers push the stock price up for the rest of the year. By the end of 2020, he's bought $76 million worth of shares at an $8 average price. To add fuel to the fire, a group of investors on Reddit called Wall Street Bets noticed something rare. The hedge funds were so sure that GameStop would go bankrupt that they shorted 142% of the shares. This means a lot of GameStop shares have been shorted twice. But how is that possible? Like the example before, somebody borrows a stock from a lender and sells it, waiting for the price to drop so they can buy it back cheaper. But the buyer can turn around and lend that same stock to another person, unknowingly lending out the same stock twice. Now, two lenders are promised the same stock will return to them. But with 142% of short interest, there aren't enough shares for all the borrowers to buy back a stock and return it to the lender. This puts a lot of pressure on the borrower to find a stock and is known as a squeeze. The borrower may be forced to buy the stock back at a higher price and lose money. Seeing this, the people on Reddit bought as many shares as possible. They wanted hedge funds to have no stocks available to buy when they needed to close their shorts. This would force hedge funds to pay higher prices to end their bet against GameStop, and for once, lose a lot of money at their own game. And it worked. So many people were buying the stock that the price was shooting up. It shot past $100, $200, and $300, eventually peaking at $483 per share. Everybody was making 10 times their money. Hedge funds were unable to find stocks to buy and close their shorts. It was all working. Nobody was willing to sell their shares, so this was going to keep going. On January 28, 2021, something had gone wrong. Robinhood, the most popular app for trading GameStop shares, stopped letting people buy. So many people were trading on the app that Robinhood didn't have enough collateral with their bank to cover all the trades. That morning, they had $700 million of collateral, and they needed $3 billion more, and only anticipated $1.4 billion more, leaving them with a $1.6 billion deficit. If they didn't meet the requirement, they would have to freeze all of their customers' trading. Instead, they chose to stop people from buying GameStop so the price wouldn't go any higher. However, they still allowed customers to sell their shares, which would drive the price down. Lower prices would allow Robinhood to fall back within their collateral requirements without having to raise more money. Robinhood defended their actions, saying customers could still sell, which is better than having their money frozen altogether. In reality, Robinhood had poorly planned their risk management and chose to manipulate the stock price at the expense of their customers. Another suspicious part of this is that Robinhood's biggest customer is a financial firm called Citadel, and Citadel had a large investment in a hedge fund called Melvin Capital, who was getting crushed by their large short position in GameStop. A price drop would help Melvin Capital and make Citadel a happy customer. It could be a coincidence, but if it walks like a duck, you get it. A week later, the price had fallen 97% to $15 a share. The historic squeeze was over, and hedge funds had lost $12.5 billion in January. Melvin Capital, who had averaged 30% returns every year up until 2021, took the brunt of it, losing 55% of their capital. Citadel offered a helping hand and gave Melvin Capital $2.75 billion to help recover, but the recovery was limited, and Melvin still ended the year down 39%. It wasn't until May 2022 that Melvin announced they were returning money to their investors and closing the firm. It's been a year and a half since GameStop's meteoric rise and fall, but it's still at $25 a share, higher than it had ever been before the big squeeze. This was a rare event where retail investors overpowered the larger institutions, But keep in mind that the institutions eventually did kill this movement. It's hard to argue that the stock market is a level playing field, but this will go down as one of the most successful retail investor stories of all time. Thank you for watching, and be sure to check out my other videos.